You know, usually when we look at political polling, um, it feels a bit like checking the morning weather forecast.
Yeah,
You
exactly.
get a percentage, maybe a margin of error, a little map with red and blue clouds moving across the screen.
Yeah.
I mean, it's incredibly passive. You just sit there, look at the screen, and basically just hope it doesn't rain on your parade.
It is entirely passive. You're just a spectator, watching the societal barometer slowly rise or fall over the course of like 18 months.
Right. But then you step onto the floor of a political prediction market, and suddenly that passive weather map is replaced by this high-speed ticker tape.
Oh, it's a completely different world.
It really is.
Mm.
You aren't just watching the weather anymore, you are actively trading the raindrops. And the board we are looking at today is moving at lightning speed. So welcome to today's deep dive.
Glad to be here.
Our mission today is to explore this absolutely fascinating intersection of high-stakes finance and politics. We're pulling from a pair of really in-depth articles published on the Predmart blog back in June of 2026. And we are focusing specifically on the 2028 Democratic presidential nominee odds.
It is a remarkable ecosystem to observe, really, because it completely strips away all the traditional cable news punditry.
Yeah, all the yelling.
Right, exactly. We're looking at a space where the talking heads are replaced by the cold, hard mechanics of capital allocation. I mean, people are putting real money on the line to back up their opinions.
And just to be totally clear with you listening right now, before we jump into the numbers, we are looking at this purely through the lens of a trader today.
Yes, very important distinction.
We are going to mention a lot of prominent politicians and recent political events, but we aren't taking any political sides. We aren't making endorsements, and we certainly aren't endorsing the viewpoints of the blog sources we're analyzing. Our mission is simply to decode how traders on these platforms price human beings as tradable assets.
That distinction is really the only way to understand the data. We are analyzing market behavior, not political platforms or ideology.
Right.
A trader does not care if a candidate has, the best housing policy. A trader cares if that candidate's price is about to go up or down.
Exactly. And to set the scene for you, this is not just some niche hobby for political junkies playing with monopoly money.
Not at all.
We are talking about serious, world-class volume. The data shows that on platforms like Polymarket right now, there is over $1 billion in volume sloshing around just on this single 2028 Democratic nominee board. I mean, it's massive.
Over $1 billion means we have a highly liquid, highly active market. And the fundamental shift in mindset you have to make right away is that for leverage traders on platforms like Predmart, the raw odds, like the actual percentage number next to a candidate's name, are often totally irrelevant.
Wait, really? The odds don't matter?
Not in the way you'd think. The board is constantly repricing, week to week, day to day. Traders aren't betting on who will ultimately be president in 2 years. They are hunting for momentum.
Ah, okay. They are trying to exploit the velocity of a price moving today.
So to understand how traders view this billion-dollar market, we naturally have to start right at the top of the board. And this is where we learn that simply having the lead isn't always a good thing for an asset.
Yeah, the top can be a tough place to be.
Look at California Governor Gavin Newsom. He is currently leading the entire board at roughly 24%. But his price has actually drifted down. Back in March, he was trading around 27%.
And that downward drift is the critical data point. I mean, for months, he has been the undisputed frontrunner. But the price is moving in the wrong direction for a market leader. It's bleeding.
Okay, let's unpack this. It sounds to me like treating a politician like a tech stock right after a major product launch. The hype is over, and now traders are looking for the next shiny thing.
That's a perfect analogy. The articles point out that all of Newsom's previous catalysts are now fully priced in. We're talking about his high visibility clashes with the Trump administration over redistricting and the National Guard, his aggressive social media posture, that massive podcast push.
Right, all of that is in the rearview mirror.
Exactly. All the things that built his lead have already happened. The market has already digested that information.
What's fascinating here is the underlying mathematics of how a trader views that kind of stagnation. To a casual voter watching the news, a drop from 27% to 24% sounds like, well, statistical noise.
Yeah, just a 3-point difference. Who really cares?
Exactly. But to a trader looking at the contract itself, a drop from 27 cents to 24 cents is an 11% decline in the asset's core value. And direction matters far more than the raw level when we are this far out from an election.
Because he's run out of fuel for the moment. I mean, the data notes that Newsom has explicitly signaled he won't make any major decisions until after the 2026 midterms. So he essentially removed his own near-term catalysts. There's no shiny new product announcement coming next week to push his stock higher.
He is completely parked. And when the leader is parked, the capital gets bored, the money leads to find action elsewhere, and that pushes the price down even further.
Wow.
This is where the mechanics of shorting in a prediction market become incredibly relevant. A fading frontrunner is actually a much cleaner setup for a leveraged short position than trying to throw darts and bet on a rising star.
I want to pause you right there because I think a lot of people listening hear the word shorting and immediately think of Wall Street, where you have to borrow a stock, sell it, and hope to buy it back cheaper. How do you short a human being on a platform like Polymarket?
It's actually much simpler than Wall Street. In these prediction markets, every candidate has a yes contract and a no contract.
Okay.
If Newsom's yes contract is trading at 24 cents, his no contract is trading at 76 cents. If you think he's parked and you think his momentum is dead, you simply buy the no shares.
So you aren't borrowing anything? Nope. You are making a direct, measurable bet that gravity will pull his price down. If his yes drops to 20 cents, your no shares rise to 80 cents, and you profit from the decline.
So you're basically betting on gravity.
Precisely.
Yeah.
It is much easier and far more consistently profitable to bet that a stalling leader will slowly lose ground than it is to guess which of the 20 underdogs is going to suddenly rocket upward.
That makes a lot of sense.
It's a highly efficient trade, especially when you apply leverage. A trader on Predmart might use 5x leverage. Suddenly, that boring 11% drop we talked about earlier, that translates into a 55% return on their actual capital.
That is wild. So the frontrunner's momentum is stalling because he's waiting for the 2026 midterms, and traders are actively profiting off that boredom. The natural next question is, well, if all this trader money is flowing away from the guy in first place, where is it going? Who is the shiny new object?
Right now, the main mover on the board, the one sucking up all the oxygen and all the trading volume, is Senator Jon Ossoff. Yes. The data highlights a massive jump for Ossoff. He moved from 7% to 9% in just a matter of days. That jump actually pulled him roughly level with Alexandria Ocasio-Cortez for second place.
Which is a really fascinating contrast.
Yeah, because Ocasio-Cortez sits at that 9 to 10% mark because she has a strong structural base of younger Democrats. She has an established floor. Ossoff, on the other hand, got his jump from a sudden, volatile wave of momentum.
Specifically, a widely shared New York Times opinion piece making the case for an Ossoff run, combined with his strong Senate re-election prospects and just a general wave of favorable media coverage. That is pure narrative momentum.
But there is a massive catch here that makes this entire situation completely wild. Ossoff has explicitly stated on the record that he has zero interest in running in 2028.
He has.
Here's where it gets really interesting. Why on earth would the market buy stock in a candidate who is publicly telling everyone he isn't going to run? Isn't that just lighting money on fire? I mean, you wouldn't buy stock in Apple if the CEO went on television and said, yeah, we are never making another iPhone.
This raises an important question about how traders interpret public statements versus market sentiment. What you just described is what traders call a textbook divergence.
A divergence.
Yeah. You have the Polymarket board pricing him up based on outside enthusiasm, the op-eds, the media buzz, the donor whispers, while the candidate himself is publicly waving it off. Stated reality is fundamentally diverging from the market narrative.
But if the CEO says no, shouldn't the trader sell?
Not if the volatility is the actual product. Traders thrive on a divergence because it creates a genuine two-sided trade.
Meaning what, exactly?
A two-sided trade just means there is a way to make money, whether you believe the hype or whether you think it's total garbage. Remember, a contract going from 7 cents to 9 cents might seem tiny to a voter, but to a trader, that is close to a 30% gain on the position in under a week.
Oh, wow.
Right. If you apply that 5x leverage we discussed, that single wave of hype can pay for itself many times over.
Okay, so walk me through the mechanics. How do you play both sides of a guy saying no?
Well, let's look at the yes side first. You bet that the buzz is real. You buy the yes shares at 7 cents because you believe the media push and the rising market price will eventually create so much pressure that he is forced to launch a real campaign.
So you're riding the wave.
Exactly. You are catching that sudden wave of hype. You don't even need him to actually run. You just need the hype to push the price to 12 cents, and then you sell and take your profit.
And the other side.
The other side is you buy the no shares. You fade the trade entirely because you believe the man's own words. You think the market is completely overheating on a single New York Times op-ed, and the moment the news cycle moves on, his price will crash back down to 5 cents.
I see.
Either read is completely actionable. The vital thing for the trader is simply that the mispricing is live and the market is moving.
That makes total sense. You aren't betting on the presidency at all. You are betting on the tension between the hype and the reality. So we have a stalling leader in Newsom bleeding out from 24% and a surging candidate in Ossoff catching a massive momentum wave while saying he won't run. This kind of fragmentation at the very top of the board has to create massive ripple effects for everyone else.
No, absolutely.
If all this money is chasing a guy who won't even run, what does that mean for the actual established politicians who are actively trying to win? They must be getting ignored.
It creates an incredibly wide landscape of opportunity, especially for the established names who have seen their fortunes shift, and for the deep field of underdogs. Because the pie is fractured, the pricing becomes highly inefficient.
The most striking example of a shifting fortune in this data is Kamala Harris. The blog describes her as the cautionary tale of the entire board.
Yeah, that's a very accurate description.
She entered the cycle as the highly recognizable 2024 nominee. A year ago, she was polling in the high 20s and 30s. But now, she has steadily bled support down to a single-digit market price, sitting around 7%.
A collapsing former frontrunner is an entirely different species of trade compared to a stalling leader like Newsom. When you are watching an asset in free fall, the market punishes it severely.
Because traders don't want to get stuck.
Right. Traders hate trapped capital, and they hate downward momentum, so they short the asset all the way down. The only question for a leverage trader looking at a 7% price tag is trying to determine if she has finally found a floor or if there is still further to fall. Her price decline has been one of the most reliable directional moves for short sellers over the past year.
But once you get past that 7% mark, you enter what we can call the deep field. This is where the prices get really, really cheap.
Yes, the bargain bin, so to speak.
You have established governors and cabinet members.
Yeah.
Josh Shapiro is sitting near 5%. Pete Buttigieg is around 4%. Andy Beshear is in the low single digits. The data points out that these three men all have actual viable institutional paths to a nomination that the market is currently discounting heavily.
Which presents a very specific profile for a long-term trader. If you have a convicted read that one of those institutional paths is going to open up, maybe you see a demographic shift or an upcoming legislative win, you are looking at an incredibly underpriced asset. You are buying a highly credible candidate for pennies.
And then it gets even wilder. Below the governors, you have the genuine dark horses. People like Representative Ro Khanna or even late-night TV host Jon Stewart sitting down there in the low single digits. The articles literally call these contracts lottery tickets.
That's pretty much what they are.
So what does this all mean? How does a trader sitting at their computer actually choose between shorting a collapsing former frontrunner who is trying to find a floor versus throwing $100 at a literal late-night comedian?
If we connect this to the bigger picture, the unifying point of this entire market is the math of fragmentation. Gavin Newsom, the frontrunner, is sitting under 25%.
Okay.
That means the overwhelming majority of the probability, over 75% of the pie, is spread thinly across the rest of the field.
The pie is shattered into dozens of tiny pieces.
Precisely. And because those pieces are so tiny, the contracts are trading for pennies on the dollar. Thin-priced contenders offer the most asymmetry. Let's look at your Jon Stewart example.
Yeah, let's.
If you put $100 on a candidate priced at 2 cents, and a viral moment or a sudden wave of grassroots support pushes that candidate to just 10 cents, you haven't just made a small profit, you've 5 extra money.
Man, that's incredible.
If you apply leverage, the returns become astronomical. The cheapest contracts carry the most leveraged upside per dollar, provided your underlying thesis actually lands.
Okay, so we've mapped out the mechanics of the entire board. We have the fading leader waiting for the midterms, the surging denier riding a media wave, the cautionary tale in free fall, the underpriced institutional governors, and the dark horse lottery tickets.
We've covered the whole spectrum.
But knowing who to trade is completely useless without knowing when the market is actually going to move.
Timing is absolutely everything, especially when you are paying fees to hold a leveraged position. Traders do not want to park their money in a flat position through 2 years of mindless political noise.
This sounds exactly like earnings season on Wall Street.
It really is.
You don't want your capital tied up doing nothing for 3 months. You want to position yourself right before the quarterly earnings report comes out because you know that's the specific day the stock is going to aggressively gap up or gap down.
It is a great analogy, but with a major twist. A corporate earnings report can involve, fuzzy math or forward guidance that softens the blow. A political election is raw, irrefutable, binary math. You either get the votes or you don't.
Right, there's no spinning the actual vote count.
Exactly. In prediction markets, traders are hunting for those discrete, schedulable gaps where the market is forced to face reality, and every single line on the board reprices at the exact same time.
And according to the data, the absolute dominant catalyst, the biggest earnings report on the entire calendar, is the 2026 midterms.
That's the big one.
The midterms are going to validate or puncture several contenders simultaneously. Newsom has explicitly tied his own decision-making to the midterm results. Ossoff's own Senate re-election is happening then, and a strong showing there feeds directly into his presidential narrative.
A leverage trader's entire edge is identifying that specific date and positioning themselves just ahead of that midterm repricing window. They want to be fully invested the day before the votes are counted, capture the massive price swing, and then exit the trade.
But the midterms aren't the only event. There is a whole timeline of post-midterm catalysts. Once the 2026 elections are over, you get the formal campaign launches. Then you get the first real polling that reflects declared candidates, rather than just abstract name recognition.
And then, perhaps most crucially for the structural map of the race, you have the Democratic National Committee's decision on the 2028 primary calendar.
The DNC calendar. Why does scheduling matter so much to a high-speed trader?
Because the calendar dictates the physical laws of the race. The DNC is expected to finalize that decision by early 2027. It determines which early states actually matter.
Oh, I see.
If the first voting state is a traditional Midwestern state versus a Southern state with a totally different demographic makeup, it completely changes which candidates have a structural advantage.
Right.
The moment that calendar is announced, the probability of certain candidates winning gaps up or down instantly. It is a massive trading window.
And platforms like Predmart are built specifically to exploit that window. A standard market might give you the raw odds, but these leveraged platforms allow you to size your conviction for these specific dated events.
Exactly.
They allow you to turn tiny, slow market adjustments into major actionable trades right when the DNC press release drops.
It's all about reading the direction of travel, waiting patiently for the scheduled catalyst, and sizing the position to maximize the gap.
It really is a completely different way of processing the daily news. And I think that is the biggest takeaway for you listening today. Even if you never log on to a prediction market, even if you never place a single leveraged bet in your life, looking at politics through this specific lens is incredibly valuable.
I totally agree.
Because it totally strips away all the emotional punditry. You aren't listening to talking heads argue on cable news about who should win. You are looking at the cold, hard probabilities of what a crowd of highly incentivized people actually believe is going to happen.
People putting their money where their mouth is.
Exactly. You see the true, unfiltered value of the candidates, and you know exactly when the pivotal moment, the midterms, the calendar decisions, are going to force reality to the surface.
It forces a remarkable kind of honesty onto a system that usually thrives on spin. But it also leaves us with a rather provocative thought to consider, one that goes slightly beyond the data we've discussed today.
Oh.
Well, the numbers emphasize that there is over $1 billion sloshing around these political prediction boards. And with leverage, traders are sizing their reads well past their actual cash deposits. The sheer amount of capital is staggering, and it's only growing.
It's a financial behemoth disguised as a political poll.
So the question becomes, if these prediction markets continue to scale and the capital involved gets big enough, at what point do they stop merely predicting the political weather and start creating it?
Wow. That is a slightly terrifying thought. You're saying the market could literally fund a campaign into existence.
Think about the mechanics of it. If a potential candidate like Jon Ossoff, who's currently saying no, or a dark horse who hasn't even considered running, suddenly sees their stock price surge on a platform like Polymarket.
Oh man, that surge generates media headlines.
Exactly. Those headlines generate donor interest. Could that very market momentum, that massive influx of trader capital seeking a return, be the exact catalyst that convinces a dark money pie to step in, which then convinces the candidate to actually launch a campaign?
That is wild to think about.
We have to ask ourselves, are we just watching the barometer, or is the barometer starting to summon the rain?